Is a 7% drop in Domino's pizza stock a disaster or the exact opportunity we've been waiting for? In the next few minutes, I'm going to show you how to analyze a fallen giant like Domino's, contrast it with the high-flying AI stocks that are dominating the headlines, and reveal a third asset that central banks are quietly hoarding. Domino's is currently trading near its 52-week low. Many are running away, but let's look closer. The company has an incredibly strong franchise model and ambitious growth plans. More importantly, they have been aggressively buying back their own shares, which has massively boosted their earnings per share. This is a classic move from a quality business that believes in its own future. The current weakness in consumer spending, driven by high interest rates, is hurting them now, but is that a permanent problem or a temporary headwind? My valuation models suggest a potential upside of 40 to 60% from these levels. Of course, you have to be comfortable with volatility. If you buy with conviction, you must be prepared for potential 15–25% drops along the way. That's the price of admission for potentially great returns. This is what value investing can look like, finding fundamentally good companies that are temporarily out of favor. The market will eventually recognize their value. If you're getting value from this breakdown, take a second to subscribe to the channel. It's free and helps you stay on top of these opportunities. Now, let's switch gears completely. On the other side of the market, you have the momentum names. Think about stocks like Astera Labs or CRDO. These are companies in the AI space that have been on fire. This is momentum investing. Momentum is simply a measure of how much a stock has been going up over a period of time. It's not about meme stocks. It's about identifying strong trends. BlackRock just bet big on this trend, with its infrastructure partners pouring money into data centers, recognizing that the AI revolution needs a colossal amount of energy and infrastructure. This is creating a huge bottleneck, which is why energy companies like Energy, which is set to power Google's new $4 billion data center, are positioned to do extraordinarily well. The key with these high-flying momentum stocks is risk management. It's not wise for a new investor to put a large chunk of their portfolio into a stock that has already shot up parabolically. The secret is to get in early, or if you're late, to limit your exposure. Don't bet the farm on a speculative idea that isn't even profitable yet. We've talked about value and momentum, but the investment landscape is always changing. And later, I'll tell you about a company with huge latent growth that has just taken a big hit. But first, let's talk about a classic safe haven: gold and silver. Despite their recent run-up, I believe we are at the very beginning of a third major cycle for precious metals. This is not the time to sell. It's the time to hold and even continue buying. Why? Because central banks themselves are buying gold at a frantic pace. They are doing this because they are losing trust in their own fiat currencies. Fiat currency is money that a government has declared to be legal tender, but is not backed by a physical commodity. With massive government debt and persistent inflation, the value of our dollars, euros, and pesos is deteriorating. Gold and silver are real, scarce assets that protect your wealth over time. Silver, in particular, has massive upside potential. Not only is it crucial for industrial uses, but the paper market for silver is leveraged to an extreme degree compared to the actual physical supply. This sets the stage for a potential massive short squeeze. The gold-to-silver ratio is also at a historically high level, suggesting silver has much more room to run to catch up with gold. So, how do you put this all together? You need a balanced approach. You can own a quality business that's temporarily down, like Domino's Pizza. You can have exposure to the biggest secular trend of our time, AI, through best-of-breed companies while managing your risk. And you can protect your portfolio with real assets like gold and silver. As for that beaten-down growth company I mentioned, look at MNSO. It's a retailer that has taken a substantial fall recently, but is trading at a reasonable 14 times forward earnings, with interesting growth potential in the Chinese consumer market. Every investment must have a thesis, and when the facts change, your thesis must change too. That's the key to navigating these markets successfully. What's your strategy right now? Are you hunting for bargains like Domino's, riding the AI wave, or stocking up on gold? Let me know in the comments below, and don't forget to subscribe for more insights.